Steven Roy Goodman, host of Higher Education Today. Welcome back to the education program that connects you to contemporary issues, people, and institutions involved in the world of higher education. Today's show is a special joint production of the University of the District of Columbia and Prince George's Community Television. I'm here in Largo, Maryland, where we'll be talking about reducing student loan debt. Elizabeth Baylor is Associate Director of Postsecondary Education at the Center for American Progress. Previously, Elizabeth worked for the Senate Committee on Health, Education, Labor, and Pensions, and the White House Office of Communications Research. Jason Delisle is Director of the Federal Education Budget Project at the New America Foundation. Jason has been a contributing analyst to the Peterson-Pugh Commission on Budget Reform and an analyst for the Senate Budget Committee. Welcome to both of you.
Thank you.
Thanks.
Well, we're so delighted you could come here. Maybe if we could start with, why is there so much student loan debt in the United States? How did we get here, and what should we do about this?
Well, one of the important things to keep in mind is that there are more people going to college now. And we also have to keep in mind that student loans are not going to just sort of traditional type of college student that we think of, the sort of four-year school. A lot of student loans are made at two-year schools, community colleges, and also a lot of student loans are made at graduate school. It's about 40% of it.
I also think that it's important to know that for-profit colleges also have experienced quite a growth in enrollment in the last few years, and there are a lot of students who borrow who go to those schools. It's also important to know that while it's a good thing that there are more people going to college, the amount of debt that each individual student owes has been growing in the past few years. I think that's partly to do with the fact that states have had budget crunches at their level, and they've been able to invest less in college, which means that many families have had to pay more in tuition and fees.
So students are paying more for tuition and fees, but can you give viewers a sense of how much debt? What's the average debt right now per student, and how much cumulative debt is there?
So cumulatively, there is about $1.3 trillion in student loan debt. Most of that debt is loaned through the federal government, and some of that debt is loaned privately through banks. A recent analysis found that for students who graduated college, four-year college, in 2013, the average amount that a student owed was $28,000.
Right, so the sort of what is the average balance? I mean, becomes a sort of tricky question, right? It's sort of average balance when they left school, or the average balance on the entire stock of outstanding debt, which may be at various points of repayment. And then you also need to distinguish, it's very important to distinguish between what type of degree. So Elizabeth talked about $28,000 for a four-year degree. But there are people who are completing two-year degrees who are graduating with significantly less than that. There are people who are pursuing master's degrees who are graduating with significantly more than that. So we know on the graduate degree side, for example, the average amount of debt that students are leaving with now is somewhere around $50,000, $45,000.
Well, these are high numbers. Why wouldn't this scare some prospective students?
Well, first of all, we should back up a little bit from the high numbers. So it's really important to understand what the monthly payment is on these loans. So you'll see that both of us went immediately for the average balance, and that's what you asked for. But we don't typically think of the average balance on mortgages. We want to know what people owe monthly. And we don't think of average balances on car loans. The most important number on a car loan is the monthly payment. In fact, if I asked you what you paid for cell phone service, you wouldn't give me the 10-year cost of your cell phone service. You would give me the monthly number. So it's important to know, for example, about the median monthly payment on outstanding student loans is around $150, $175. So that's very different than the $1 trillion number, and very different than the $30,000 number. $150, $175 a month is not necessarily a sort of crisis level number, I think, for a typical person in the United States.
Well, let's take that $150 per month of debt. So how much would I have borrowed at the University of XYZ to have that $150 that I owe per month, and how long would that be for?
So this is one of the tricky things. Most of the loans are federal student loans, and they come with a lot of different options for repayment. You can pay them over 10 years. You can extend the term out to 15, 20, even 30 years. You could pay them back based on a share of your income. You could make interest-only payments for a few years. So we don't have a great sense of how all that breaks down. But for someone with a $150 monthly payment, $175 monthly payment, you're looking at something like $20,000, $25,000 in debt.
And how long would they be paying that $150?
The average term on loans is around 12 to 15 years right now on the stock of debt.
So does that not trouble you? You don't seem terribly troubled by that number.
Not necessarily. No, I mean I'm not necessarily troubled by it. It looks like if we had a student debt crisis at $150 a month, then we also have an auto loan crisis. We definitely have a mortgage crisis. We probably even have a cable bill and cell phone crisis.
And what do you think about that, Elizabeth?
Well, I think one of the important things to think about is the fact that the number of borrowers has increased substantially over the last 7 years, for example. In 2007, we had 28 million Americans who had student loan debt, and they owed, on a per-student basis, about $18,000. Today, that number is 44 million, and the per-student amount is $28,000. So some of the crisis that people think about, or that Jason referenced, is to do with the fact that these amounts are increasing quickly. I also think at Center for American Progress, we have done a lot of work on the issues related to the middle class and the economy. And many middle-class families are facing tighter budgets than they have in previous generations and previous decades. And so it's important, if wages aren't going up, that $150 actually looks like a lot more of your monthly budget. And it's important to think about it for the broader economy, because if a person could pay off their student loan debt, that money that they had in the bank wouldn't be money that stayed in the bank. It would be money that would be pumped back into our economy. We see that young Americans, millennials, are forming households at slower rates than previous generations, and they're not going to go to Bed Bath & Beyond and buy new sheets and buy new towels and all the things you need to set up a household if they're paying debt and living with family because they don't feel economically secure.
But the other way of looking at that is that person who's now not getting those things to start that household, why wouldn't the argument be that maybe they should have gone to less expensive schools?
I absolutely think that choosing the right school at the outset and making decisions to minimize your student loan debt is really important. The Obama administration has done a lot of work to develop a college scorecard. And what that would do is show students in a very plain language way, what is the average debt? Is it high, medium, low at the school you're looking at? What are the outcomes? Are a lot of students graduating? One of the things we know is that people who struggle with student loan debt tend to be the people who actually didn't complete their program. And so first, I agree that if a student has $150 worth of student loan debt, but they finish their program and they're able to pay and they got a wage premium from the job that they got after school, then that's actually not a big deal. But if they didn't complete their program and they're stuck in the same low-wage jobs, that's a much bigger worry.
So I wanted to go off of your example about how if people are spending money on repaying their student loans, then that's money that's not going to something else in the economy. But actually, it is money that went to something in the economy. It went to higher education. In fact, they actually spent money they didn't have on a higher education, which by the same logic should be boosting the economy, right? So if we're talking about you can't spend the money on that because you spent it on a higher education, and that therefore is a drag on the economy, but you actually spent it on the economy of higher education, which should be getting a boost. So I'm not totally convinced that this people borrowing money and spending it on higher education is somehow a drag on the economy. In fact, I think most Americans would find it very strange at this argument that people borrowing money to go to college is actually hurting the economy.
Well, I've heard that argument made overseas where people make that point that you're making. but I haven't heard it right here in Washington. That's an interesting point. But why can't we ask some universities to kick in some more money to prevent some of this money flowing into debt?
I mean, we certainly can. We can ask them to do that, but people are paying the prices that the universities are charging. I mean, I think this is, we can certainly ask them to do that, but for now, people are willing to pay the prices and incur the debt. It's important to recognize, though, that most people are bumping up against borrowing limits in the federal student loan program. The vast majority of people who have student loans are using federal loans. It's almost like 95% of the loan issuance is federal. They can only borrow, I mean, many people will be surprised to know they can borrow their first year as a dependent student. It's only $5,500. So this is not really an issue of where tuition keeps going up and up. People keep borrowing more and more to pay for it. The tuition has long surpassed the limits on the loans. So I don't see this as an issue of if they lowered prices, you'd see debt go down necessarily. I think we've sort of reached the natural limit of what people can borrow in federal loans.
But what about merit packages? A number of students, of course, are trying to do what they can to get the highest amount of money for a merit package. What do you think about that? What do you both think about that?
Center for American Progress, where I work, has done a lot of work to make sure that there's equity in higher education. And one of the things that we're really concerned about is making sure that children or young adults from low-income backgrounds have the financial resources to go to college. I was looking at a report recently that showed that young adults from the lowest income families only graduate college at a rate of about 10%, compared with high-income folks graduate college at a rate about 80%. And so one of the things about merit-based aid is that it's a trade-off for institutions. They look at merit-based aid and they look at need-based aid. And we think that need-based aid helps make college more affordable for folks from lower income backgrounds, and we think that's a good thing because we think that having more need-based aid is a good thing because we want to make sure that the people who need the most help to go to college are able to afford it.
But with all due respect, that's a public policy argument. How do you argue to Mr. and Mrs. Jones, who may be a middle-class family, that merit package for an extra few $1,000s is not going to come their way because the money isn't there?
I think that's a really tough question. There are different types of aid that happen for different people in different parts of the economy. We have tax credits that go to middle-class families that don't flow to low-income families at same rates. So the American Opportunity Tax Credit is something the Obama administration created and expanded, and it provides quite a bit of tax relief for folks who are from middle-class families. Once they pay the tuition, they receive a tax refund at the end of the year. And I think that you need to make sure that college remains affordable for all students, and I agree that middle-class students should have benefits as well.
Jason, do you have a thought or two about that?
I don't really have a dog in the merit aid fight, so no, I don't have a comment on that one.
Well, in terms of, to get back to your point about the idea about the parity before, I wonder if both of you could say a word or two about what do we do now? So do we say, well, income-based repayment is such a great idea that what we're going to do is we're going to encourage people to do community service and military service to reduce the debt, and of course help our society at the same time? Or do we say, well, that doesn't exactly flow, to Elizabeth's point before, that doesn't necessarily flow equally to society?
So you're talking about income-based repayment option on the student loans. I think that there's a little bit of a misunderstanding with the income-based repayment program that exists. For undergraduates, for people with $20,000 or $10,000 in debt, the income-based repayment program is by and large a safety net. It would be something that you would use temporarily to reduce your payments, but you're going to extend the term on your loan, and you aren't going to have debt forgiven. Unless something has gone really wrong in your situation. But for those who go to graduate school, income-based repayment is something that provides a lot of loan forgiveness. This is because the graduate students can borrow a lot of money in the federal loan program. I stated the loan limits for undergraduates. many people will be surprised to learn that there are no loan limits for graduate students in the federal loan program. So income-based repayment for them is very much so a generous benefit that's helping offset the cost of tuition for graduate school. But for undergraduates, it's still really just a safety net program.
I agree that for most graduate students have a better, more likely chance of getting a loan forgiveness because they take out larger amounts of debts. There's also one program called Public Service Loan Forgiveness, which is for people who do jobs that serve the community and serve society, like teachers and nurses. Also people who work at nonprofit organizations and who work for state, local, or federal government. Those folks, if you are on an income-based program as an undergraduate and you have reduced payments for some of the 10 years that you work, you can receive some forgiveness at the end of the 10 years. I think that I saw an estimate that said that 25% of people in the workforce work in a job that might be eligible for this kind of loan forgiveness. You can also have situations that I'm sure Jason will talk about in which people who have graduate school debt use this program. But I think that one of the key things to think about is that it was designed for people like nurses and for teachers and people who, firefighters, cops, people who really serve our communities. And I think that there should be greater awareness of that program because it can help people repay their loans easily.
So maybe if you can walk us through that, how would that work? So let's say I wanted to be a nurse, and how would I get that income-based repayment?
So one of the things that I think is really important about student loans is on the front end of college, public policy experts have spent a lot of time making sure that it's easy to get aid, it's easy to sign up. They want to simplify the forms. On the back end, there have been so many new repayment plans added on top of each other. I think about 8 or 9 plans. And so sometimes it takes a lot of work on the back end to figure out what plan are you eligible for. It depends when you borrowed. It depends what program you borrowed under. But a large share of workers are eligible for pay-as-you-earn or income-based repayment, which are 2 words for different types of loan repayment plans that are very similar. One has slightly more generous terms. The best place to go is to call your servicer or to use the U.S. Department of Education's website. They have a database that you can sign in with your name, your date of birth, your Social Security information, and it will give you back what loans you have and what plans you're eligible for. And then you work with your servicer or with the Department of Education to sign up. But Public Service Loan Forgiveness, what it does is you sign up for an income-based repayment plan, and then you also get your employer to help you fill out a form that says I work at an organization that is eligible, or I work in a job that is eligible. People often think about it as people who work for nonprofits, but if you work for a hospital and you're a nurse, but your hospital is a for-profit entity, because of your occupation as a nurse, you're eligible regardless of the organization that you work for.
And Elizabeth, you alluded to Jason maybe not agreeing with all of that, and that may have something to do with the article I read recently in the Washington Post that you wrote. If I understood this correctly, you didn't agree with that because you thought that the benefits flowed in a way that wasn't fair?
Well, right. So Elizabeth talked about public service loan forgiveness going to a group of people who are, I believe you said, I think, serving society. Right, so a nurse working at a nonprofit hospital is serving society then. A nurse working at a for-profit hospital making the exact same income is not serving society under this program. So that is very, very unfair. She will not, or he will not, receive loan forgiveness if he's working at a for-profit hospital. If he's working at a nonprofit hospital, he would receive the loan forgiveness. Again, even if these 2 nurses are earning the exact same income. So it's a real sort of unfair bias toward the tax status of the entity. And the irony is that the eligibility is still based on income. So you have two people who are earning the same income, but one qualifies for a much larger loan forgiveness number just by working at a particular institution.
Well, let's assume that you're right. What do we do about that?
Well, I don't think you need public service loan forgiveness. You can make payments based on your income already. So the loan is affordable.
So in your view, it should just be about your income, your income, and your income.
Right, and I think you need to provide a final loan forgiveness number between 20, 25 years, depending on the amount of debt you start with. I think that's perfectly reasonable to have a the way that income-based repayment works is what you do is you let people make payments based on their income, and then you sort of let the clock run and see who earns their way out of it. And then when the time is up, if someone is still has debt, then you forgive it. So it's very important to sort of let the clock run it long enough in terms of how many years you have to pay before you get the loan forgiveness to sort of sort out who can pay and who can't. 10 years under public service loan forgiveness is far too short to determine that.
But where do these numbers come from, the 10 or 20 years or 25 years? Why isn't it 5 years? Why isn't it 30 years? Why isn't it 7 years? Where did these numbers come from?
They're totally arbitrary. Legislators and policymakers more or less made them up. Yes, I know. In fact, this is one of the things that got the Obama administration in so much trouble. The original income-based repayment program that was enacted in 2007 had a 25-year loan forgiveness number. So you make payments, and if you haven't paid off by 25 years, then you have any remaining debt forgiven. Well, most people have paid off their debt by then. The Obama administration made changes to the program and reduced it to 20 years. And they also lowered the amount you pay from 15% of income to 10%. Without really thinking about what that meant. They were just nice round numbers. They lopped 5 off both the numbers. And what that means is they sort of tipped the balance now very much so in favor of having the debt forgiven rather than repaying, without really knowing what they were doing.
So what should the administration do now?
Well, I think a really important thing they need to do is you need to provide the loan forgiveness, the amount of time someone has to pay needs to be somehow linked to the amount of debt they have. So this is the issue, is if you have $10,000 in debt or $100,000 in debt, you still get your loans forgiven after 20 years. Well, who's likely to have debt at the end of those 20 years? So what you would want to do is have a longer repayment term for the person who starts with more debt. It just makes sense. That's the way you should operate that.
Should we somehow separate out nurses and engineers and poets? Should we do it by category?
I don't think you really want to go down that road. I think that's a sort of that's a very messy fight in terms of picking winners and losers, and I think we've already gone too far with the public service loan forgiveness benefit. I think that's already trying to split the economy into jobs that get more loan forgiveness and jobs that get less. And I just think that's politically fraught in terms of trying to pick winners and losers in that way. I mean, income-based, if payments are based on income, that should sort it all out.
Well, but how do we let's go back to the back end of this in terms of the tuition. How can we encourage politely, especially state institutions, to reduce the amount of aid, to reduce basically the tuition, or to increase the amount of aid to offset that tuition? How do we do that? How do we encourage that to happen?
Well, so at the Center for American Progress, we put out a report in which we called for the federal government to make an investment that called for states to match the money that the federal government brought to the table. We have looked at the retreat that the states have made since the onset of the Great Recession, when budgets got very tight, and we found that 29 states cut the amount of money that they were devoting to higher education outright, and about 44 states cut the amount when you measured it on a per student basis. So what we said is that the federal government should give grants to states, and if the states matched it. We also asked for some performance incentives from states. We would like to see states increase the number of students who graduate on time. We would like to see states do things like align the graduation requirements for students who finish high school to the admissions standards for the public college in your state, so that you know when a student finishes high school that they are prepared to start learning in college and they will learn successfully.
But in both those paths, basically it's costing the government more money.
Yeah, I think it is costing the government more money, but I think that it's important. I think that higher education is something that has shown over and over to produce a great bounce. People who graduate from college are less likely to be unemployed. They earn more over the course of their lifetime. If you actually look at it internationally, many countries around the world are recognizing that the jobs in our modern economy require higher education in a way that they didn't as much a generation ago.
So I have to ask, though, if it's such a great payoff and it's such a great thing, why are we here having this conversation? Why are we concerned about the amount of debt? Why are we concerned about the cost if it's so great and it pays off so well?
I think
obviously one of the pieces, something is wrong here. Either it doesn't pay off as the way people believe it does, because they wouldn't be as concerned about cost or debt, or it does pay off and we really don't need to be worried about the debt.
I think that one of the differences is that we've actually retreated quite a bit from a generation ago in how much money is coming from public sources and how much money is coming from individual sources. And so part of the reason is that we've retreated the amount, we've decreased the amount of public support, which has in turn meant that more families are borrowing more. Tuition is a bigger share of the revenues at many public colleges than it was a generation ago. And so what I think should happen is that we put back that investment that worked out really nicely for the United States in the post-World War II second half of the 20th century.
Do you have a response to that, Jason?
I mean, I think there's definitely widespread support for everyone to keep tuition very low, for all the states and the public institutions to keep tuition low, and for there to be an increase in state appropriations. I think most people are definitely for something like that. But I do think it's important to realize that when we can't also talk about how high the payoff is in higher education, but also talk about how concerned we are that people are paying too much for it. But I would like to point out that I think some of the anxiety around student debt and tuition really comes from graduate school. And we don't do a good enough job of separating out when we're talking about, are we talking about graduate school or are we talking about baccalaureate and sub-baccalaureate degrees? And like I said at the beginning, 40% of that outstanding student debt is graduate school. It sort of makes that $1.1 or $1.3 trillion number look a lot different. And, we have this anxiety over graduate school, and we talk about what should we do. Well, one of the things we could do is the federal government can stop making unlimited loans to graduate students. That would be one of the ways to start reining in tuition at graduate schools, to sort of cut off the spigot of unlimited debt. That would also help with some of the student debt problems. That would reduce the amount and would significantly reduce the increase in debt levels. And that is, by the way, where some of the really big increases in student debt have been over the years. The amount of debt that undergrads are leaving with, or two-year degrees, has been ticking up a little bit, just slightly above inflation. But that makes sense, and if we believe the rhetoric around college degrees are really worth it and very valuable, it makes sense that those are going up. On the graduate school side, the amounts of debts have absolutely skyrocketed.
Well, I think we're going to have to leave it at that. Thank you both. If you would like additional information about Elizabeth Baylor or Jason Delisle, please visit AmericanProgress.org or NewAmerica.org. If you have comments or suggestions about higher education today, please send an email to our viewer mailbox at highereducationtoday@topcolleges.com. Thank you for watching. We will continue to bring you quality discussions about important matters in today's college and university world. Please join me again for another edition of Higher Education Today. I'm Steven Roy Goodman, and you've been watching Higher Education Today.